Welcome back, institutional stakeholders. We've got a really exciting explainer for you today. We're going to dive deep into Sandisk's fiscal third quarter 2026 analyst briefing. And honestly, we have a ton of complex data to unpack, from just absolutely unprecedented revenue surges down to the nitty-gritty mechanics of their manufacturing joint venture.
Real quick, before we jump into the hard financial data, please remember that this video is for educational purposes and not financial advice. All of the analysis we're covering today is based purely on publicly available preliminary financial results and the forward-looking statements from the company's recent earnings presentation. Okay, here is our roadmap for the briefing. First, we'll hit the Q3 2026 financial highlights. Second, the data center end market expansion. Third, the Sandisk-Kioxia joint venture structure. Fourth, long-term strategic growth. And finally, we'll wrap up with forward-looking risk factors.
Let's get right into it with Section 1, Q3 2026 financial highlights.
The sheer velocity of this top-line growth is just wild. We are looking at total revenue hitting $5.95 billion for the quarter. To put that in perspective, that's a massive 97% quarter-over-quarter growth and a 251% jump year-over-year. So where is all this coming from? Well, Edge revenue is still their largest raw segment. That brought in $3.66 billion, which is a really healthy 118% sequential increase. Consumer is actually the only lagging indicator we're seeing here. It came in at $820 million, down about 10% from the previous quarter, though it is still up year-over-year. But the real star of the show, the segment that is literally redefining their entire financial profile, is the data center market. That segment pulled in $1.46 billion. We're going to isolate and really dig into that segment in just a second.
Let's see how this builds into their forward guidance. This exceptionally strong Q3 sets the stage for a blockbuster Q4. Management's non-GAAP business outlook for the fourth quarter is projecting revenue somewhere between $7.75 and $8.25 billion. But honestly, as an analyst, the metric that absolutely jumps off the page is their projected gross margin. They're forecasting between 79 and 81%. Now, you know as well as I do in hardware manufacturing and memory design, touching an 80% margin, that indicates massive pricing power. It points to a severe supply-demand imbalance that is working heavily in Sandisk's favor right now. And that flows straight to the bottom line, giving them a projected diluted net income per share of between $30 and $33 for a single quarter.
Which brings us to Section 2, data center end market expansion.
The momentum happening here is just brilliant. Think about this. A year ago, in Q3 2025, the data center segment generated $197 million. Fast forward to Q2 2026, it climbed to $440 million. And now, it has completely exploded to $1.467 billion. We're talking about a 233% quarter-over-quarter growth rate and an astonishing 645% year-over-year leap. This isn't just organic growth, right? This is a complete paradigm shift. The company notes this is being driven by further expansion into the fast-growing data center end market using their leading technology, and we can safely infer that this is being heavily fueled by the massive infrastructure build-out needed for enterprise artificial intelligence.
All right, moving right along to Section 3, the Sandisk-Kioxia joint venture structure.
Now, you might be wondering, how does Sandisk even have the physical capacity to scale this rapidly without completely blowing out their operating expenses? Well, to understand that, you have to understand their critical operational partner, Kioxia. This relationship is built on a massive joint venture framework spanning from 1988 all the way to 2025, and it represents the operational heartbeat of Sandisk's flash memory production. So how does this complex flow of intellectual property and manufacturing actually function? It's like a giant puzzle, but we can break it down into 3 core steps. Step 1, Sandisk and Kioxia co-develop flash technology that includes process tech and memory design, and they both contribute their IP for use by a shared manufacturing entity called Flash Ventures. Step 2, Flash Ventures takes that IP and performs the integral manufacturing and R&D functions at their dedicated sites. And then Step 3, this is the real financial kicker, Flash Ventures sells these completed wafers back to Sandisk and Kioxia at cost, plus just a tiny markup. Furthermore, Sandisk pays Flash Ventures expenses, including equipment depreciation, and charges those back. This structure creates a phenomenal operational moat. It allows Sandisk to share the astronomical R&D and CapEx costs of semiconductor fabrication while securing a guaranteed cost-controlled supply of wafers to meet this exploding data center demand.
Let's transition over to Section 4, long-term strategic growth.
Management is executing on several key strategic fronts to secure future revenue stability.
First up, they have secured 3 new business model, or NBM partnerships. What's absolutely vital for institutional investors to note here is that these NBMs are backed by firm financial guarantees. Look, in a historically cyclical memory market, locking in guaranteed revenue goes a long way to smooth out future earnings volatility. Plus, they are expecting to secure 2 additional NBMs in the upcoming fourth quarter. This strategic positioning is backed by an absolute fortress of a balance sheet. Their cash and cash equivalents have more than doubled since a year ago, now sitting at a very robust $3.735 billion.
And what do you do when you have billions in cash, skyrocketing margins, and you fully paid down your debt? You reward your shareholders. Sandisk just announced a massive $6 billion share repurchase program. By retiring debt and authorizing an aggressive buyback of this scale, management is sending a very loud, very clear signal about their confidence in the company's long-term free cash flow generation and their commitment to driving up shareholder value.
Finally, Section 5, Forward-Looking Risk Factors.
It's time for a bit of a reality check. If you dig into the dense forward-looking legal text in their earnings presentation, we can distill it down to 4 distinct operational and macroeconomic threats that institutional investors absolutely must track. Number 1, macroeconomic conditions, specifically evolving trade policies, tariff regimes, and inflation. In a highly globalized semiconductor supply chain, trade wars are a tangible, very real threat to those 80% margins. Number 2 is their reliance on the Kioxia relationship. Yes, the joint venture is a great operational moat, but it's also a single point of failure. Any disruption with Kioxia directly impacts Sandisk's wafer supply. Number 3, AI operational risks. The exact same thing driving their data center growth, AI, also poses integration and operational risks within their own internal business systems. And lastly, number 4, the execution of the separation from Western Digital Corporation. Achieving the expected benefits of this split requires completely flawless operational execution moving forward. We have just looked at a 233% sequential growth rate and gross margins touching 80%. The operational framework is incredibly efficient, and the capital allocation is highly shareholder-friendly. It is a fascinating pivot from consumer storage straight into enterprise AI infrastructure, and the data suggests they are executing it brilliantly so far. But the ultimate test for Sandisk's executive team will be managing this hypergrowth while navigating global tariffs and maintaining a highly complex joint venture. So the question remains, can Sandisk maintain its unprecedented data center momentum amidst AI operational constraints and macro volatility? Thank you so much for joining me for this briefing. Like and subscribe for more videos.